Free markets are supposed to be pure. Money flows freely, capital goes where it's treated best, and efficiency emerges naturally. That's the story. But here's the mystery. If free markets work so well on their own, why do even the most capitalist economies quietly restrict money when things go wrong? Why, in moments of crisis, does every government, without exception, reach for capital controls it publicly claims to oppose? The uncomfortable truth is this: no free market survives without limits on freedom. And the system depends on you not noticing. The idea of free capital flows rose alongside modern capitalism. In theory, removing barriers lets savings fund productive investment worldwide. Economists praised open markets as self-correcting and stable, but history tells a different story. Long before the phrase capital controls became controversial, governments understood something vital. Uncontrolled money movement can destroy economies faster than bad policy ever could. The tension between freedom and control has been baked into markets from the start, and it only becomes visible during stress. In the 19th century, under the gold standard, capital flows were technically free, but only because money itself was constrained. Gold limited how much credit could expand, acting as a natural brake. Once that constraint disappeared, the danger emerged. After World War I, nations tried to restore pre-war financial openness without restoring limits. Capital rushed in and out of fragile economies. Banking systems cracked. Governments collapsed. The lesson was clear but politically inconvenient. Free capital without safeguards amplifies instability. After World War II, policymakers tried something new. Under the Bretton Woods system, trade was encouraged, but capital movement was restricted. Countries could rebuild without constant financial whiplash. For decades, this hybrid system delivered stability and growth. But by the 1970s, inflation, deficits, and political pressure dismantled the framework. Capital controls were framed as outdated, inefficient, even immoral. Markets were liberated. Money could move anywhere, instantly. The assumption was that discipline would replace control. What followed wasn't stability, it was crisis. Latin America in the 1980s, Asia in 1997, Russia, Argentina, and countless others. Capital flooded in during booms, then fled overnight at the first sign of trouble. Each time, the same pattern emerged. Rapid inflows inflate bubbles. Sudden outflows collapse currencies. Governments intervene quietly. Capital controls were reintroduced under different names. Emergency measures, temporary restrictions, macroprudential tools. The market was free until it wasn't. Even today's most vocal free market defenders enforce hidden controls. Banks face movement restrictions. Pension funds are guided. Central banks intervene to manage exchange rates. During crises, withdrawals are limited, transfers are delayed. Regulations tighten overnight. The irony is unavoidable. Capitalism survives by suspending itself when necessary. Economists proposed alternatives: better transparency, smarter regulation, market discipline. But no model solved the core problem: human behavior. Capital moves fast. Fear moves faster. When panic hits, markets don't self-correct. They self-destruct. So governments step in not to abandon markets, but to save them from themselves. Today, trillions move across borders in milliseconds. Emerging markets build reserves as insurance. Developed nations quietly manage flows through regulation and monetary policy. When stress appears, the playbook is always the same. Freedom during calm, control during chaos. It's not a flaw. It's the design. First, free markets are not self-sustaining, they require boundaries. Second, capital controls aren't anti-market, they're anti-collapse. Third, the real debate isn't freedom versus control, but how much instability societies are willing to tolerate. The open question is this: as money becomes faster and more digital, can these quiet controls keep working, or will the system face a crisis it can't contain? If you want to understand the hidden mechanics behind global finance, subscribe, stay curious, and keep questioning what free really means.